Welcome to this month's edition of the Society and Mental Health Seminar Series. My name is Verity Buckley and I am the Impact Projects Manager for the ESRC Centre for Society and Mental Health here at King's College London. In case you're not aware, the aim of the centre is to undertake research to better understand the relationship between society and mental health, shifting the narrative away from the individual to focus on social structures and the changes that are needed to promote and sustain good mental health in communities. This seminar series is designed to discuss centre-related themes, incorporating a critical perspective about their importance and what needs to happen to facilitate actual real-world change. We invite a range of speakers from academia, civil society, and communities to discuss differences in experiences, attitudes, and interpretations of society. This could be in relation to race, ethnicity, and gender, as well as the socio-political backgrounds and power dynamics behind such differences. This seminar, we will be exploring gender bias in financial advice, a really important component of our work addressing equality and diversity and impacts on well-being. The session will be led by Dr. Ylva Baeckström. Ylva is a former banker and fintech entrepreneur and now a psychotherapist, lecturer, and academic researcher at King's College London Business School. She is an expert in behavioural finance with a special interest in gender and relationships in finance and entrepreneurship. She is passionate about creating positive change through her research, conveyed through the Economic Equality Impact Group she established at King's, and is also currently authoring a book on the topic. Ylva will be delivering a 30-minute presentation, which will be followed by an audience Q&A. You can submit your questions at any time using the chat function. If you're a Twitter user, you can also discuss the seminar using the hashtag Society and Mental Health. We hope you enjoy the seminar, and I'm now going to hand over to Ylva.
Good afternoon, everyone. It's really nice to see you all. Welcome. I've got a hand up from Dina. Did I see that right? No, not a hand up. So I'm going to, if you did want to say something, please feel free to do so. I'm going to share my screen and then just so I get my slide up here. If you can't see my screen, please let me know. If you can't see the presentation called Gender Bias in Financial Advice, and please let me know, and I will do something about it. But otherwise, I assume everyone's okay. So we're going to be talking about a few things today. Importantly, we're going to be talking about the importance of investing to secure your financial future. And then we're going to be touching on financial advice. And I'll also give you some tips on what you need to do in order to sort out your personal finances. Clearly, this is an area I'm extremely passionate about because over half of the population in the UK, and it's the same all over the world, it's worse in many countries, do not know what to do in order to save for their financial future. I mean, there's hardly anybody I speak to who knows how much money they need to have in their pension pot in order to secure their retirement. So it's a really important topic, and it's a really difficult one to engage with because we feel overwhelmed and all sorts of different things when we start thinking about it. So how I'd like to do this, if possible, is to ask you to, if you have burning questions during my presentation, please do put those in the chat. I can't see the chat box while I'm presenting. Possibly Verity can see it. Can you see the chat box while I'm presenting, Verity? Can I just check that with you?
Yeah, I can see it.
Okay, so do put them in the chat, because sometimes if I say something that a concept that doesn't really come across, or that you don't quite understand or want clarity on, it might be that sometimes you get lost for the rest of the presentation. So just feel free to interrupt me. I really don't mind that. But I'll tell you a bit about, Verity did say something about me already, but I work at King's Business School. And since 2018, so I'm relatively new to academia. And my previous career, I've been an entrepreneur and I was a banker for many years working in the city. And I gave up a really well-paid career in order to dedicate my future career to improving the financial lives of people and contribute to research in this area, and really extremely excited about the opportunity. Actually, every single person you help increase the knowledge of, they will help somebody else, and the knock-on effects that has on society is really, really powerful. Particularly, I'm interested in gender equality because I feel that gender equality underpins the scope for actually a much broader intersectionality in business. So because normally when you're the underdog and you get an increased powerful position, or you're taken a bit more seriously, you then help others around you. And of course, women are known for having a much more collaborative leadership style, and which improves innovation, improves profitability, and all sorts of different things that you probably all know about already. I can talk to you about that in more detail in another seminar. I've also recently become a guest researcher at a business school in Gothenburg, Sweden, particularly because they're interested in the gender research that I do. My PhD is from CAS Business School, now called BASE, and I'm also a relationship psychotherapist, and that means that I have a private practice, a small private practice, where I help people, individuals and couples who struggle with relationship problems. So I'm really interested in what we get out of our relationships with people, because everything we do, the relationship on Zoom is a little bit different to a relationship face to face, of course, but nonetheless it's a relationship, and we feel differently about ourselves and about each other depending on who we are in that relationship with, and that's very linked to finance as well. So it looks like it's a little bit slow my end to change the slides over, so I'll have to wait for that to happen. There we go. So why do we need to take responsibility for our retirement provision, for how much money we have when we retire? It's because 8% is not enough. And 8% is here on the slide for a reason. It's because it's part of what's called auto-enrollment that we're going to talk a little bit about later on. But people, and especially women, need to save more in order to secure their retirements. And this is really, really important, because we don't save enough, which means we end up being poor in retirement. And of course, we also live longer, as you know, and we're living longer and longer, which means we need more money to sort of survive for the rest of our lives. And women live longer than men, which means that women need more money than men, not less money. And if you didn't know, these are some of the facts. If you would like to have a minimum annual income of £10,200, I challenge you to live on that in London. Then you need a state pension pot, which is part of, we'll talk about what state pension is a little bit later. You need a retirement pot at 68 to be £47,300. That means you need to save an average of £86 a month from the age of 22 all the way up till you're 68. Most of us don't start at 22. So people start thinking about it much later on than 22, which means you need to save a lot more, and you're only going to get 10,200 of an annual income that you have to pay tax on. But of course, that falls below tax thresholds, but you pay tax on your pension income, remember. If you like a moderate income, 20,200 per year, you need a pot of £377,000. Now it starts to be quite a lot, doesn't it? You have to save £800 per month between the ages of 22 and 68. If you want to be a bit more comfortable, £31,000 per year, then £734,000. People don't know this. We can discuss this later on, but most people have no idea how much of a pot they need in order to secure that income that they would like to have at retirement. And of course, the state pension, we'll come back to that, which you pay through your national insurance contributions, is also included in these calculations. So it's not just the calculation of what you save with your employer. So let's think a little bit about gender. Okay, women are paid less than men. In the pandemic, we know this is not a pandemic presentation, but we know that we have reverted up to 40 years in terms of gender equality. We know that the UN takes gender equality very seriously. The European Commission takes it very seriously, but still they say they take it seriously, but nothing is done about it. It's getting worse day by day. So the pandemic has been terrible for women. It's been much worse for women of color, of course, and it continues to get worse. So it's even more important that you take action now. So let's think about, these are numbers from 2018, I think, but it's about the same now. It'll probably be worse again. But of course, they conveniently stopped reporting. You know how organizations in the UK of a certain size have to report the gender pay gap. But in the pandemic year of 2020, they stopped that requirement, which is a complete insanity in my view. Why you would stop it when you need it the most? King's College, for those of you who work there, is about 14% gender pay gap. And when it comes to bonuses, it's 83%. I'm just telling you, it's terrible. So you work for an employer that, if you work for King's, that is not doing what it should, but we need to fight more to do that. So if you're a woman, or indeed a woman of color, please do fight for your pay and say in the organization that you work for today. So women are paid up to £260,000 less than men over their careers. The gap widens in the women's when they are in their 40s. Why? Because women are conditioned by society to be the main carers for children and the domestic providers, and business is not set up to allow for women to participate in the employment market to the same extent, and also have time to mother their children. So these are just the figures right in front of you there. You have the average wage, the wage in the UK for a woman, 26,000, the average wage for a man, 31,000. And part-time, you see the gap is even more, 18,000 for women and 29,000 for men. So that is the reality in the society we live in today. When it comes to pensions income, it gets worse. You see it says minus 43 there. Let's go back to the previous slide. It says minus 18 on this slide. And what happens here is, because if you save 8% of 26,000, if you're a woman between the age of 22 and 67, and you save 8% as a man of the wage, which was 32,000 nearly, then you obviously you accrue an income, or you increase the capital of your investments, and then the return is sort of the cumulative return means that 18% goes to 43%. It means that even though you earn 18% less during your career, you then have a pension pot worth 43% less than that of a man, or the average man, the average woman here. This excludes any time that women might take off for looking after children. So normally when a woman takes a few years off to look after children, she stops paying into her pension. And this figure does not include that break in a career. So it's really important to take this seriously. The pensions income, as you can see, there's a 24% difference in the pension income. Now remember that women live longer than men, so that means that women actually technically need more, not less, to survive their retirement. I don't mean to scare you too much, but it's quite important. Now, when it comes to women and investing, nearly all academic research finds that compared to men, women feel that they know less about investing. They feel less confident about their investment decisions, and they're less risk tolerant. Now, these are on average for women in society and excludes sort of wealthy and successful. And in my research, I find that women who are managers, women who are successful, women who sort of made it in the man's world do not necessarily feel the same. But nonetheless, it's really important that these differences exist. And that means, of course, that women and other excluded customer groups, because there are many other people who also lack in confidence and knowledge about investing. It's certainly not exclusive to women. It includes lots of other people too. But it can mean that you're less motivated to engage in your finances, which is obviously quite sad, because it means you have even less in your retirement. So let's think about why you need to invest. Inflation, we've all heard about. These are a little bit old numbers, but the concept is the same. So let's say the RPI, the retail price index, which is the normal inflation number, which is the cost, the increase in the cost of goods and services in the UK. So this is basically the average increase in the cost of living, if you like. When you live in the UK, milk gets more expensive. So does spaghetti, so does everything else, and particularly with Brexit, you've seen differences in prices, how it accelerates more. So if you do nothing with your money, if you just sit on it, put it on your mattress, you will lose inflation, because your money becomes worth less every day because of the rise in the prices in the general market. If you leave the cash in the bank, you'll earn an interest of 0.6% perhaps, or nothing. Because interest rates are so low, then you'll be using 2%. That's, of course, before we take in tax into consideration, because you might have to pay tax on your interest as well. But as you know, interest rates are really low now. So when interest rates are lower than inflation, leaving money as cash in the bank is pointless, because it's not going to earn you anything. But you're going to lose slightly less than if it's under your mattress. So you need to earn more on your employment income net of tax, more than inflation. So you need to earn more than 2.6% on your savings in order for your money to grow. And here we can just see the effect of inflation over 40 years. If you had 100,000, you will end up with something around 70,000 or thereabout. So basically inflation erodes the value of your money or your savings over a period of time, if you do nothing with it. So, okay, so that's that. Now let's think about investing. So I hopefully I have set the scene for you in order to show you that we need to invest. If we don't invest, we will be poor in our retirements, or poorer. So now let's think about what the difference between investment and wrappers are. This is something, so much terminology floating around when you talk about investments. So now, portfolio management is something you hear about. Portfolio management is an investment strategy. It's where you combine a number of investment assets. You've heard about stocks and bonds, interest rates, foreign exchange, property, alternatives, commodities. All of those things are what's called asset classes. And asset classes are often combined into a portfolio that has a certain investment objective. So as an investor, you might say, well, I would like to have a return of 8% per annum. Okay, if you want a return on 8% per annum on your investments, it means you have to take a relatively high risk in your investment. If you want a return of 5% per annum, you can take lower risk with your investment. So when you invest your money into a portfolio of assets, or in funds, you heard about mutual funds probably, then you take different levels of risk, and that will produce different potential levels of return. Now you can hold these investments in a different wrapper. Okay, so if you think about a piece of I don't know, if you buy sort of Heroes, you buy a box of Heroes, you have different chocolates in each wrapper. So if you think about the portfolio being all these different asset classes in the box of Heroes, the wrapper is what's around the investment. So you hold the investment in different wrappers. Now, wrappers is typically could be a pension fund or an ISA, or a mutual fund can also be a wrapper. So let's think about the wrappers for a bit. I'm going to try not to make it too complicated. So let's first think about ISAs. So an ISA is a tax efficient way of investing, right? It's a tax efficient wrapper. And in that wrapper, you can put different things, different investments. You can hold a portfolio of investments inside the ISA. So for example, you can hold cash, you can hold stocks, bonds, property, all sorts of different investments within the wrapper. Now, how it works in the UK is that you take money, you take money that you've paid tax on, and you place it in an ISA. And you can place up to £20,000 a year in an ISA, and any return that you receive on your ISA is tax-free. You pay tax before you invest in the ISA, but then the return or interest or whatever you earn within the ISA is tax-free. So that's how it works. And you can hold up to £20,000 per year. So if you've got £20,000 spare per year, pop it in an ISA or whatever it is, how much you put in there. Because if you do it today, if you invest in something today that in 20 years time has gone up by 20%, you will receive that 20% without having to pay tax on it. Now, a pension fund is another wrapper. Okay. Now that this wrapper receives tax relief at your highest rate of income tax, whatever you pay in income tax, let's say you pay 20%, you will get 20% relief on the amount that you put into your pension, which means that the government will give you 20%. If you put £100 in of your own money, you will actually put £120 in. So £120 is invested for you. But when you draw your pension, when you finally retire, you draw your pension, you pay tax on the money that you draw in your pension. Now, I'm not focusing on mutual funds. I'm just mentioning mutual funds because you've heard of them, and they are there's a holding vehicle in which you can hold lots of different types of investments within that. So it's almost like the mutual fund can be the portfolio within which you can hold, and you pay a fee to buy a mutual fund. You can buy stocks and you can buy different things instead, but it's just, for terminology wise, it's just good to know that a mutual fund is a vehicle that can hold lots of different types of investment assets within it. Now, let's think about pensions, what they are. So it's a long-term investing, of course, especially if you start at 22, which you should have done. If you're not 22 yet, then you're lucky you can get to start. It's a long-term investing, and it's a tax-efficient wrapper. Remember that you get tax relief going into the pension, but you pay tax on the pension that you draw out. Now, there's a state pension that the government provides for you, assuming you pay your national insurance contributions. There is also something called a defined contribution, which is the workplace pension or a personal pension, a SIP you might have heard of. All of those things fall into a defined contribution. It means you define how much you contribute. So just to illustrate that, I'm not going to jump back on the slide because sometimes there's a lag in doing that. So I'm not going to go back to all the slides. But remember when I showed you how big the pots needed to be and how much you had to save per month if you wanted an income of 10,200 per year, I think it was, for example, you needed a pot of, let's say, 47,000. The contribution you had to make was £800 per month in order to get there. That's the definition. Your contribution is defined to be 800. So that's where that terminology sort of derives from. There's also the old style defined benefit pensions, which is where you had a guaranteed final salary pension. They are dying a death, and that's only because it's not affordable anymore. I'm not going to cover today the USS pension scheme because that might not apply to everyone in this meeting. But if you would like a slide on the USS pension scheme and you find it incredibly difficult to understand, like everybody does because it's very difficult to understand, then feel free to connect with me and I'll send you a slide that explains that to you, but it might not be relevant to everybody in the meeting today. Oops. So let's just think about workplace pension. So there's something called auto-enrollment in the UK, and that came in, I think, 2014 or something like that, or 18, or I can't remember what year it was. But auto-enrollment is the UK government's way to try to force employers to save pensions on behalf of their employees. So what it means is that an employer has to put you in a pension plan where you contribute at least 8% of your qualifying earnings. So you pay 5% and the employer pays 3%. And that's the minimum. You can normally contribute much more than 8%. And I can tell you now, and I started off by saying that today, that 8% is not enough. You're not going to get as big a retirement pot as you need if you only save 8% of your earnings into your pension. But you can opt out of this, but you should never opt out of your pension, because you're giving money away, because you are getting from your employer at least 3%. In order to qualify, you need to, the qualifying earnings are between 6 and 50,000 per year. So for example, you can look at a calculation example down here. You don't have to worry too much about it, but if you have an annual investment of 1,920, for example, 5% equivalent, so if it's 1,200 is the gross amount, 960 is paid from the employee, because you get the tax relief on your investment into the pension. So this you can look at in more detail later on, but remember, you get that 20% or 40% or 45% contribution from the government in order to put money in your pension. So depending on your age, you need to think about what you're investing. Generally, what happens, and we're not going to go through masses of detail of this today, but generally what happens is that you have a lifestyling in your pension, so that when you're young, you invest in much higher risk assets. And then as you get older, you slowly reduce the risk that you take with your investment, because you have less time until retirement, which means that your time horizon for investing becomes shorter, and you can't take as much risk with your money. So auto enrollment 8% is an important thing to remember. Then we have state pension. And here it's important that you get 35 years. It's very important. So do check your national insurance contributions. It's very easy to check, and it's on my tips. I'll have a tip slide for you later on, because you get at the moment, it goes up with inflation, but you get 8,000 odd pounds per year in pension income from the government if you have maxed out, if you have at least 35 years of national insurance contributions, and you can go back and backdate your contributions. So for example, if you haven't lived in the UK for that long, but you're a little bit sort of age in your career, go and top up your national insurance contributions going back in history. When I did this, when I ran a full investment lecture once, a woman in King's came up and said to me, oh, afterwards, a few weeks later, you've taken such a worry out of my mind, because she, for the first time, went and looked up her national insurance contributions, and she thought about it for so long, but she never did it. And that was just such a relief to have had look at that for her. So do have a look at it if you haven't already. Okay, so this is just some additional information. It is a valuable benefit, because to buy an annuity, and we might not know what an annuity is a guaranteed income. So it's almost like you buy a guaranteed income to last you throughout retirement. And it would cost £327,000 to buy an annuity that gets you £8,767 per year in income. So it's a really worthwhile doing that to make sure you pay them. So it could be that if you take a career break, you stop paying them. So if you take time off with children, if you're a man, you're a woman, or identify a different gender, then make sure that you make your contributions to national insurance, even though you're not working, or top them up later on. Now, we talked about 22 earlier, which is So basically, the auto-enrollment, which is the 8% rule, remember we talked about how the government has put this rule into place, that employers have to put their employees into a pension scheme, and that 8% has to be contributed to that. However, there are exclusions to this, which is absolutely ridiculous. So if you're less than 22, you're excluded. So even if you're earning, but you're under the age of 22, employers do not have to put you in a pension scheme. Or if you're over the state pension age, fair enough. If you're over state pension age, they no longer have to save for you. If you earn less than 6,136, you are excluded, which again, the ridiculousness of this is just, it's beyond considering, because the people who really need to save in their pensions are the ones who don't earn enough. So you could have several jobs earning less than 6,000 a year and you will still be excluded. You can still opt in, but the employer contributions are not compulsory. So the people who really need them are excluded. You can, of course, make your own pension. We'll talk about that a bit more. Now, if you're on parental leave, you can be excluded because it's based on different rules. If you're self-employed, you're excluded. So there is a vast population in the UK of self-employed people who are completely excluded, left to their own devices to sort out their own pension, which, if you're a florist or you have a building construction company or you're an IT developer or whatever you are also asked to become an expert on pension, because you have to sort out your own pension. You don't have anyone doing it for you, and the government is not going to look after you. Obviously, you'll pay your national insurance contribution, but you also need to make sure you have a SIP, a self-invested pension scheme. You need to sort that out for yourself if you're self-employed. It's never too late to start, and it's never too early to start. Now, what holds people back from investing? We talked a bit about that earlier when we said about gender differences. And here, if you were in the room, I'd ask you to sort of contribute to what holds you back. Now, what holds people back is that we feel we don't know enough. We don't feel motivated. We're lacking confidence. It just feels hopeless. It's too complicated. And it is complicated. And it doesn't have to be complicated, but it is immensely complicated. But there is help. You can get help from financial advisors. And that's also very scary, the scary process to go through. But I did promise that I would talk about financial advice a little bit today. And I'm just going to talk about some of my findings in my studies about financial advice and some of the bias, the gender bias I've seen in the financial advice profession. And then I'm going to open up for Q&A, but do save up your questions and feel free to sort of ask me whatever you want at the end. Now, financial advisor is a person who is regulated by the Financial Conduct Authority, and it's a person whose job it is to help you manage your finances, help you give investment advice, provide investment information and investment advice to you. They charge for their services. They typically charge as a percentage of the money you give to them. So let's say you give £100,000, if you have that much money, it's nice. And they charge a percentage of the amount that you give them, or they charge product fees based on the products you buy from them. It can feel like a really scary process to go to find a financial advisor. And again, if you do find financial advice, I would urge you to be picky, and I would urge you to make sure that you feel safe and secure in that relationship with your financial advice. Some of the research I'm working on now with colleagues is looking at how actually what people really need from their financial advisor is containment, feel trust and feel secure in their relationship with a financial advisor rather than just receiving financial advice, because finances are filled with anxiety for a lot of people, and they might have debts, they might have financial trouble, so they feel they don't know things about money, and that's a process where people feel quite insecure and anxious, and therefore they need to feel safe in the relationship with a financial advisor. So I would really urge you to find somebody who you feel that with, and if you don't feel that, don't trust them with your money, find somebody who makes you feel comfortable. Now, in my research, I looked at very wealthy people in private banking because my background is in private banking. I was managing portfolios for wealthy people in my career. So I suppose in a way, and at times in my career, I was a financial advisor. And I was interested. I noticed when I worked in the city, I noticed that we seem to be treating men and women differently when we went to give them advice and when we had meetings with them and etc. And I was interested in doing research on where they would judge them the same. So I sort of combined my psychotherapy expertise with my investment expertise and looking at this in more detail in my PhD. So I was interested in understanding, are we biased? Do we judge the same woman and the same man the same if we could ever have the same woman and same man? And because the way that we judge others, it affects how we behave towards them. Obviously, it's obvious, but we sort of forget about that in financial services. And how we feel judged, how we feel understood by other people affects how we feel about ourselves. So I embarked on research where I created little descriptions of people, like I described a woman and I described a man. So I would describe, for example, a 45-year-old woman who was an entrepreneur, and she had £1 million to invest, let's say. And then I talked a little bit about her, whether she had children or not. And then I created 10 different vignettes. So I created 10 different investors that I described. And then I took this woman and I created and made a man out of her. So instead of maybe calling her Amanda, I called her James. And she's still 45, still an entrepreneur, still had 1 million. So it was exactly the same person, but with a male gender instead of the female gender. And I took these and I went to financial advisors whose job it was to recommend portfolios, to sit in front of clients and recommend how they should invest their money. And I asked them to judge how much they felt that this person knew, their knowledge about finances, investing, how confident they felt that this person was, and how risk tolerant they thought that the person was. As in, what portfolio would they recommend? We talked about portfolios earlier. What portfolio would they recommend that they invested in? A risk portfolio or a low risk portfolio? So I asked male advisors to do that and I asked female advisors to do it. But what I did is, because I swapped gender, remember in that vignette, in that description of the client, I could ask advisors to judge exactly the same person as a woman and the same person as a man. And there I could compare gender differences in the judgments they were making. Here I find that male and female financial advisors think that women are less confident, that they have less control over their investments than men do. I find that female advisors, so here you have the combination, you see male advisor, male investor, etc. down there, that the female advisors give the lowest risk tolerance, the lowest rating across the board to female clients. And that male advisors give the highest judgments to men. So what it means is that when the investor is a man, exactly the same man, but just had a male gender, they get a higher risk recommendation, high portfolio risk recommendation from the advisor than they do if they're a woman. And that particularly female financial advisors give lower risk recommendations to women. Now, this is important, both for gender difference in the advisor, but also for the client, because remember I said that female investors are less confident and they invest less, they're less risk tolerant. If they also get lower risk recommendations from their advisors, a double whammy. So advisors are not doing their job of trying to stretch the risk tolerance of their female investors so that they're investing enough to secure their wealth. Because of course, the more risk you take with your investment, the higher your return potential is. So then what I did is I looked at investors themselves. So I looked at how financial advisors are judging investors, and now I look at investors judge themselves. And here I find that overall, like the research says, women are less risk tolerant than men. But I didn't find that women knew less, felt that they know less about investment, or are less confident than men. However, my sample of investors are wealthy, so they have over £500,000 in investable assets, so they're wealthy. This paper is just out in the Journal of Corporate Finance. This particular study, the previous study, is coming out in Journal of Economic Behavior and Organization, and is out in European Journal of Finance. But here, very importantly, I find that women investors who have female advisors, they invest more and they feel better about themselves. So the gender of the financial advisor matters a lot for the female investor. So a woman who seeks a female advisor, she invests more, she feels more confident, and she feels that she knows more about investments. It doesn't matter what you do to the male client, whether he has a female advisor or a male advisor, it doesn't matter, but it's very important for a woman. And this is problematic because there are only 15% of advisors in the marketplace who are women. So there's a big shortage of financial advisors who are women, but women have a strong preference for their advisor to be a woman. And remember what I said earlier, it's really important that you are with an advisor that you feel comfortable with and you feel you can trust. So if that has to be a woman, then find a woman. If that's a man, then that's fine too. It just has to be right for you so that you don't feel patronized, so you don't feel that you're not stretching your knowledge and stretching your confidence and investing how you should, instead of sort of just being stuck in some sort of stereotypical behavior trait that is not good for you in terms of your investment strategy. Oops. But of course, we have a problem because I said earlier that the judgments that advisors make about the clients differ due to the gender of the advisor. So the female advisor is likely to give lower risk recommendations to a woman investor, but the woman investor on the right-hand side of the slide invests more if she has a female advisor. Now, there's two different samples, of course, here, but what it means is that the female advisor, if you're still with me, because it's a little bit sort of, it might get a bit confusing. The female advisor herself is less confident. So she mirrors her own preferences onto her female investor. So she recommends lower risk investments and she feels she knows less than her male colleagues, and that is mirrored onto the client. However, the women who seek out female advisors, they have to work quite hard to find a woman in the first place. They might inherently have a higher risk tolerance rate in the first place, and they aggressively, if you like, they have I'm actually disappointed I used the word aggressive then. They ambitiously seek out a financial advisor who's a woman. They're harder to find, and they're therefore showing that they have a quite serious strategy for finding their advisor. So they might then inherently have a higher risk tolerance. And also, as I find in my research, these women who are more successful don't necessarily have a lower risk tolerance, and they don't have lower levels of confidence or knowledge, but we assume that they do. And that's an important difference. So the way we act towards women, it basically underlines and it strengthens the bias and the negative gender stereotyping, and that's where we fall into trouble. Now, that sort of concludes what I wanted to talk to you about in terms of financial advice. I'm happy to take lots of different questions that you might have, or indeed questions about personal investment strategies that there might be. I'm just going to put up the next slide, and then I'm going to stop the sharing. It's when I did this investment lecture, I asked everybody to walk away because it was a much more detailed lecture that went through the investments in much more detail. But then I suggested that you should put together an action plan where you put down 3 things on a piece of paper that you're going to do differently, or that you're going to do in order to sort yourself out and sort of work on securing your financial future. So I said earlier, find out about your state pension forecast. Simple, you literally just go and check it on the government website. Learn about your employment pension scheme. Go find out, how does it work? If you're USS, find out how that works. Find out about your personal pension. If you are self-employed or you are excluded for some reason from this 8%, this auto-enrollment rules, then make sure you find out what you need to do in order to invest. Decide how much you want as an annual income when you retire. And this determines your pot that you need to have at retirement. Go and calculate, lots of calculation tools that you could go on to in order to calculate how much money you need. Learn about different investment asset classes. Find out. This can be distributed after the events. These are just some resources where you can go and get more information. There are lots of provisions that you can go to in order to find financial advisors, in order to get more information about how on earth these pensions work, how they made it so complicated. I have no idea. It seems pointless, but there we are. And where you can go and sort of set up your own SIP if you're self-employed, for example. You can also hold a SIP in addition to your personal, your pension investing. And for example, if you do have a limited company, if you invest your earnings in your limited company in a SIP, then you don't have to pay tax on your income, for example. There are lots of different tips that you can do, but we won't be able to cover it all today. So that concludes what I wanted to show you in terms of the presentation. And now I'd like to open up for some questions, please. Do we have questions in the chat already? I can see that. Right, so Dina, would you like to ask your question, Dina? Would you like to speak to us? You're very welcome to. Or would you like me to read your question out?
Thank you so much. It was really great. Great talk from you. So my question is quite personal. So I'm German. I've been living in the UK as a student for a number of years now. And I'm obviously thinking about, if I start to invest now, in which country should I?
Very good question. Are you going to go back to Germany, do you think? Or you might end up living in Switzerland or the America, or
probably something like that.
Yeah. So what you have to take into consideration is currency risk as well. So if you have all of your pensions in the UK and then you end up living in a Euroland and the pound devalues, it falls, then obviously your pension income is going to fall. That was a joke with the Brexit vote, is that lots of people in the UK who live in Spain and have pension income in pounds going into euros voted for Brexit. So I mean, it's all these things going on. So you have to think about that. So if you're in the UK now, make sure you get your NI contributions in, national insurance contributions, so that you get state pension qualified. Even if you don't get all of the years, do get them in. Also invest in Germany. Okay. So that you sort of smooth out your currency risk a bit, because we're so international now that we tend moving around a lot, and so it's good to have a pot sort of at least in 2 different currencies. I would save in both.
Cool. And then my next question was, if you don't know in which country you will receive a pension in, because it's unclear where I will stop working. What is the best way? Should I really pay into NIN right now, or should I just invest in ETFs instead?
You mean invest in ETFs outside of a pension?
Yes.
No, so I'm not, that's not advisable. Well, you can do that too, but if you're in the UK, you should hold them in an ISA. Because I mean, and you are not alone. We all do this. We think, oh, I'm just going to invest. I'm just going to do some ETFs or whatever. But do them in an ISA. You can open an ISA with your bank probably, and you can hold the ETFs in the ISA, because they are always going to be tax-free when you draw the money out. And most countries, I'm not a tax expert, but most countries there's a tax treaty, a double taxation tax treaty. So if you go back to Germany, then and you have tax-free income from your ISA in the UK, there might be an income you might have to pay some tax in Germany on that, or not, because it's tax-free. So if you invest outside of a pension, and I can understand that, then ISA is a really good option. £20,000 a year you can save. So please hold them in an ISA.
Thank you very much.
Now we got a question from Anonymous, so I'm not going to ask Anonymous to speak up. How long do we need to have worked in the UK to get state pension? I think you just have to be a resident. Actually, I'm not entirely sure, but I think you just have to work like from day one. As soon as you start paying tax in the UK, you pay national insurance contributions. So I think it's a number of years, but I'm not sure. I think it's probably a very quick Google search to find the answer to that. Stephanie, would you like to ask your question out loud?
Yes, thank you. And thank
Hi.
you for your lecture. Hi. It's really, I think just wanted to bring it into the broader context of the work that we're trying to do around EDI within the center. And I think it's really great to have this level, sort of granular level of information, but also thinking about what our wider, the wider work that we're doing in the center. And we specifically have one of our research programs focused on work and welfare, and very much looking at the impact of policies on mental health in particular. And I just wondered if you could speak about any research being conducted either in your group or across King's Business School or elsewhere that's been looking at these gender wealth inequalities and in relationship to mental health. And then also which policies, because you mentioned several at the beginning of your talk, do you think are best to target to better understand the impact of wealth inequalities on mental health? So really kind of try to draw together what, the focus of the talk today, but also with your work in psychotherapy and focus around mental health and relationships.
So I think this is so strongly linked with financial anxiety, and financial anxiety is so linked to your mental health, and that feeling of hopelessness that lots of people feel because they're excluded completely altogether from financial advice, for example. And I'll mention this. So the Financial Conduct Authority is the regulating body in the UK that regulates the work of financial advisors and financial institutions. Now, the average person in the UK who receives financial advice has over £50,000 in investable assets. So that excludes the vast majority of the population in the UK who never invest in anything, who don't even never heard the word pension, let alone, well, they might have heard the word, but never really properly, nobody really understands it. So there's a lot of people who don't understand them at all, and they're completely excluded and end up living on benefits. And that's extremely sad. And I have been pushing the Financial Conduct Authority to cater or try to increase their scope to cater for these excluded groups. But it's a really tough one because the excluded groups can't afford financial advice, but they are the ones who need it. But then you have the government policy with this auto enrollment that I was referring to that excludes exactly the customer groups who need it the most. So the impact on mental health for that exclusion, it's just you are stuck in that position. You can't move from it because of the policy making. So I think that the 8%, the auto enrollment needs to really be challenged. And that is obviously is from the government. That needs to be challenged from the government level. And to exclude self-employed, I mean, that is just, it goes beyond what's wise, because it's so complex to run your own business as it is already, to then also have to worry about your pension. It's very stressful. And I find this in my research is that really what people want from financial advice, and these are people who have money, is that they want management, they want help to manage their financial stress. So the mental health it's almost like the financial advisor becomes a therapist and has a very short time in order to build that sort of close, trusting relationship with their client. And we have to increase the provision of this to include. We have organizations like Citizens Advice, and they have a money advice service as well within the organization, but it's not sufficient. It's not enough to help people, because every little pound you save helps you in retirement. So it's a big problem. I'm creating a series of investment. I'm going to do what I've done with you today, but in more detail but also less detailed in different ways. I'm going to create a series of investment education lectures that we're going to release on various social media, and also creating a toolbox, an investment toolbox that just really clearly explains investing and how to go about it, just to try to make it a little bit more accessible for people. But it's a big problem, Stephanie. I don't have any solutions to it. I'm trying to do little bits on it, but they've just made the language so complicated and the process so complicated, and there is nothing out there for the average person to access. There are no ads on TV, or whoever watches TV these days, but wherever you go online, there is nothing to actually get you excited about investing at all, or show you how important it is. Hopefully that went some way to thinking about that, Stephanie. It's a difficult question to answer.
No, that was great. Thank you so much.
I can't see any more questions in the chat. Are there any more questions from anyone?
Yeah, there's a question from Emily. If you want to ask a question, you can just raise your hand and you can unmute yourselves and ask the question.
Hi, Emily.
Hi, thank you so much for the talk today. It was really informative.
Oh, good. Good.
I'm a complete kind of beginner to all of this. I'm just trying to become more financially literate. Just think it's kind of my duty as a woman to try and learn more. And I'm just sort of wondering, what kind of books or podcasts or anything would you recommend just to try and get more of a grip on it? Like, as you said, so much of it is so inaccessible because of language and things.
Yeah, you will. We are intending, and I think my colleague Maria is on this. I think I saw her name flick by earlier. We are currently working on these investment lectures, and we're hoping, if nothing goes wrong, we're going to record them September, October, and release them sort of around Christmas time. So if you hold out towards the end of the year, you will have a fully fledged sort of educational seminars and toolbox that will teach you all about this. In the meantime, I would go to and I'm going to share this with you later on, I think maybe on Twitter or however Verity wants to share them, the tips and the resources that I put down. And I would say go on to those resources. There's loads of information out there, and start reading up on the resources. That's probably what I would recommend that you do in the first place. You don't need to necessarily buy a book, but go onto the resources. There's lots of free information available, but we just don't know that it's there because nobody tells us about it.
Amazing. Thank you ever so much.
And Hannah has shared some other things there. I follow some of these too. These are Emma. Hannah, do you want to share with us what that is?
Oh yeah, it was just for Emily. There's some Instagram accounts which kind of break things down a bit more simply, and they're all run by women. And I'm also a beginner, but I found those really helpful. I use that list and explains things quite simply.
Oh, that's really good. Yeah, that's excellent. I'm going to copy that myself and put that onto my resources so that we add that on so we learn more. Excellent. Any other questions from anyone?
I'm going to be really cheeky and ask a question, if that's okay, Ylva.
Yeah, of course. Is that Verity?
It is, yeah, sorry, it's Verity. I was really struck by your comment about the fact that female advisors are often, have the same experiences or they're facing the same issues as female investors. And I wondered whether if that was something you were exploring in your research, or what kind of interventions you think might be helpful there to improve.
Yeah. So I work with banks on this, and it's confidence. It's mainly confidence. So basically, women think they know less, but they don't know less. In fact, they often know more because if you're lacking in confidence, what you tend to do is you tend to over prepare. So you end up knowing more than your colleague, but you still feel that you know less because you don't feel confident about your knowledge, and then you come across as less competent because you seem like you're nervous about something. What you need to do is to sort of focus on the confidence aspect more, and think about what you can do in order to unlock that this fear that women, because women can feel fear in situations where they're in front of risky situations. When men feel anger, there's some research that talks about that, and to actually realize that fear is not dangerous. The fear that you feel is not something to be scared of. It's something to go and get, something to actually, the fear can spur you on and give you motivation. So I think that's the main thing with that, Verity.
Thank you very much.
Anything else from anyone? Now is your chance. Eileen.
Hi, I'm actually anonymous too. Sorry.
Oh, sorry.
Changed my name till too late. First of all, thank you so much. This was a great presentation. First of all, for doing the research anyhow, and also then sharing it with us in such an understandable way.
Thank you.
I'm one of those people who is reluctant to think about investing because anytime financial talk comes up, I get an instant headache.
Yeah.
I didn't get that at all from your presentation, so I thank you for that. And your last two slides would be so helpful to have those. That would be really, really good. But mostly just thank you so much.
Oh, that's very kind of you. Thank you, Eileen. No, we share those slides definitely, so you have that information, and do feel free to link in with me, anyone as well, and we'll make sure that we will advertise it. I'm not sure if everyone on here is from King's, but we'll make sure we advertise broadly when these investment lectures are out, because every time I've done something similar to this, everybody asks, how can I find out more? And then people email me. And I was meant to do these investment lectures last year, but there was this thing called the pandemic that happened, and I ended up in this sort of homeschooling woman trap that happened to many other women, and I didn't have as much time as as I did previously. So I wasn't able to do them last year, but we'll do them this year for sure. So thank you. Really, really enjoyed talking to you all, and I look forward to seeing some of you face to face at some point in the near future. But get in touch, stay in touch if you like, and we'll share slides, the tips for you as well. I don't know if you wanted to come in again, Verity, and say something at the end.
Yes, thank you so much, Ylva. It was a really enlightening discussion, and I have lots of notes and things that I need to follow up on this afternoon.
Good.
Yes, thank you. And thank you everybody for joining the seminar. I hope you found it interesting and useful, and we'll be uploading a recording of this seminar onto our YouTube channel later this week. And further information about what's been discussed today will be shared by email. So all of those links that Ylva mentioned, we'll be sending those around to the email you registered with. If you enjoyed this seminar, you may be interested in our next edition. I'm just going to share my screen quickly. We will be joining George Plebidis, Professor of Population Health and Statistics at University College London, on the 9th of June. George will be presenting recent work on the measurement of pre- and post-pandemic findings of common mental health problems and their consequences in 6 national British cohorts. And he'll also be leading discussion on the future direction for mental health research and measurement. So I do hope you can join us there. I will now paste a link to register for this session into the chat. And there's also links for lots of ways to engage with us online. We have a mailing list you can subscribe to, a Twitter account, and also our wonderful podcast, R6 Society, which actually has a new episode on refugee mental health coming out later this month. So yes, thank you so much, Ylva, again. Thank you, everybody. That's all for us from us for now. Thank you for joining, and we hope to see you again soon.
Thank you. Bye, everyone.
Thank you.